Hello and welcome again. This is Jerry, and this is section 5 of our series on dynamic support and resistance. And we left off with our US dollar, Canadian dollar example. And this example, we're going to look at the British pound and the Japanese yen. And we're still on our 1 hour chart here, and I'd like to say something before I continue. And after the last series, I got a few questions from students. They wanted to know if this was an intraday technique or could it be used on the daily chart. And once again, I reiterate, and I did mention at the very beginning of the series, as I do almost every time, that everything I show you, it works the same way on the 5-minute chart on up to the 1 minute, to the 1 month chart, all the way if you have a yearly chart. It's the same principle, same concept. It just depends on which time frame that you personally choose to trade on. And with that being said, we'll pick up where we left off, and we'll start from, this is Friday, yesterday, Friday the I don't even know what date it is, I'm sorry, Friday, April 4th. And we'll start going up here, and we see how we go up. And right here we have a down bar as we're going up. But now, if you've been paying attention throughout the course, then you will notice something significant about this first down bar, this first red bar here, and that bar is an inside bar. So we don't want to give this red bar, a lot of credibility, because it is an inside bar. Okay, so we look to the next bar, and it's an up bar, and we're still going up. But now, dynamic support and resistance. So we move our line up, resistance line up, to the high of this last green bar. And the next bar we have is a down bar. Okay, but now look at these 3 bars after the green bar. Now that brings us to the rule of threes. And when we talk about the rule of threes, we're not talking about 3-bar support and resistance. They are related, but just to avoid any confusion right now, we're going to look at them as a standalone situation for the sake of our example. And the main thing you want to remember about the rule of 3 is this: if we're going up and the swing turns down, meaning we get a red bar, if by the close of the 3rd bar the market has not broken support, then the market is not going to break support on that swing most of the time. And we're talking about probability here once again. And if we draw our swing support, and remember we talked about this in the prior series, the prior sessions in the series, how there's a difference between swing support and dynamic support and resistance. So here we have our swing that began this little upswing here, and so this is the low, and this is going to be swing support. Now when you look at the rule of threes, you want to think about, if there are 3 down bars coming down, and that by the close of that 3rd bar and this is our third bar in this swing down. We do not break below support, the odds are very high that we're not going to break support. And so if you're short here at the close of that third bar, if we have not broken support, it's time to exit. And then in this particular situation, and this is why I say that all of our rules, when we start putting the rules together, everything starts falling into place. Because when we have this first red bar here, these two bars that follow, they're inside bars. So especially when you see an inside bar situation like this, the odds are very high that if price at the end of the third bar does not close below support, okay, it's not going to close, it's not going to break support, and you need to get out, because the market is going to make an attempt to swing to a higher high, and we can see what happened in this case. And I'm running out of time on this section 5, and we're going to pick up in the next section, section 6, and we're going to talk a little bit more about this.